It is 11 o'clock Eastern on Wednesday, June 7th. And that means it's time for Options Forum 2023. I want to welcome you to this event today. I figured I'd jump on here and wish you a personal welcome. I'm Rick Swope. I'll be one of your hosts and presenters today, along with Sean and Dave and a guest from the Options Institute and Steve. And we'll all be introducing each other as we go along, but I just want to thank you for joining us today. This is a full event. We only do this a few times a year, and today we are doing Options Forum. This is kind of a mid-level event. We're not going to be starting at the most basic level of options, but we're certainly going to walk you through a lot. I want to tell you what's going to happen today. I want to give you a little bit of housekeeping items, tell you what's coming up, and so we'll just do this really once here at the beginning, and then maybe remind you a couple things as we go along. First of all, some administrative stuff. I want to point out some things that are on your dashboard. The first thing is the Q&A button. I'm going to highlight that right now. Q&A is how you're going to send in questions or comments as we go through these sessions, and you're welcome to send those in along through the hour as we present. We'll try to keep up with those as best as possible. Also, there is a survey that I'm now highlighting. You can fill that out anytime you want. It will also pop up automatically at the end of each session. And I'm going to take just a moment and ask you to fill that out. That's really important for us. We read every single comment that comes in, and we use that feedback that you give us to fine-tune the education material that we bring to you. So thank you very much for doing that. I'll thank you in advance. Also, on your screen, you'll see a resource button, and we've added some resources in here, including downloadable PDFs of the presentations, some extra material that I think you'll find useful. So sometime during the day, take a peek at that resource list. These sessions are all being recorded today, and you'll have an opportunity. You'll get an email, but if you don't see the email, you can go to etrade.com/events. And you'll have an opportunity to watch each of the recorded sessions at your convenience as often as you'd like. Now, let me tell you a little bit about what's coming up today. We're going to start off here in just a moment. Sean's going to lead off with what's called Introduction to Spreads, a multi-leg option strategy. Sean's going to go through that and give us a lot of thought around strategy and approach and managing and that and so forth. And then coming up right after that, we've got 15-minute breaks in between coming up right after that. At 12:15 is Understanding and Using the Greeks. And Dave is going to be coming in with that one. It's going to talk about the Greeks in options, the deltas, the vegas, and so forth, and why they're important for you. Then coming up at 1:30, right after that, we have Generating Income with Credit Spreads. And that's our guest presenter today, who's Ken Keating. Then at 3 o'clock today, so we're giving you a little half-hour break there. At 3 o'clock today, we're going to start the double session on trading on the platforms. We're going to talk about trading option spreads on Power E-Trade at 3 o'clock. And then at 3:30, we're coming in with trade option spreads on mobile. Then the day wraps up today at 4:30. I'll be bringing a presentation entitled Using Price Charts to Select Option Strikes. So you see we've got a full day lined up. Now, before I turn it over to Sean, I'm going to tell you about one more thing, because this is going to be really important for you. Tomorrow, not today, but tomorrow at 12 noon, we have a special office hours scheduled. And we did this intentionally because we figured there'd be a lot of questions coming out of the Options Forum today. And office hours is going to be a dedicated 1-hour session where we're going to allow you to come in with any option question you want. And then we'll just go through and discuss, have some back and forth discussion about this. So it's a great opportunity for you to, if you've got questions, maybe you didn't get addressed today, or you think about it, a little bit more information, come on tomorrow, office hours, 12 noon tomorrow. All of this, everything can be found, etrade.com/events. And with that, without further ado, I want to go ahead and turn the first session over to Sean Howell for Introduction to Spreads. Thank you.
Rick, terrific. You got it in under 5 minutes, which leaves me 55 minutes to cover the topic. So perfect. That is great. And I think it's really cool also that you went on video. So it's kind of nice to see from time to time. I'm not going to do that, though. I'm going to just, if I came on video, one, you would be blown away by just incredibly how handsome this team is. And then you'd be thinking, wow, look at the nose on this guy. So we're going to focus directly on the slides, and then, we'll see how things work out in the future. So let us know if you like to see us or if it distracts a little bit. So welcome to Options Forum. We are, with great intention, kicking off this session with an introduction to spreads. I'm assuming many of you have already been through boot camp, and when we kind of designed this 1, 2, 3 curriculum, number 1 being boot camp, number 2 being the Option Forum, and number 3 being what we call the Option Symposium, and we'll be doing that, I believe we're doing that in mid-fall. We are trying to create this sort of seamless educational stream for you. And where we were leading off with boot camp is that we talked about like buying a call and buying a put, and then actually we had Ken Keating in the boot camp session as well talking about covered calls, and he'd introduced some diagonal spreads, which is where you're creating some obligations for yourself. And here with spreads, we're going to be combining both buying rights and then creating obligations for yourself. Now, when I'm talking about creating obligations, you may be thinking, I really don't like the obligatory side of this. With this strategy, you're going to like the obligatory side of this. So kind of got to get your brain wrapped around the idea of having to fulfill an obligation means you're going to be maxing out your profit. I've left the disclosure slide up there for a few minutes for you to take a look, and of course everything's being recorded, and you can download the presentations, the slides in PDF if you want to print them out, or you just want to zoom in and take a closer look at that. That's one of the nice things that we've created for you in the resources widget as well. Well, what is today's goal? Well, obviously today's goal is to get you comfortable with the concept of spreads. But there's another thing about spreads that when someone says, what's the best strategy, I really dislike the word best, because the market's always changing and always doing something else, or doing something different. And you need to have the skill set to be able to apply the right strategy to increase your probability of making money in any market. Doesn't matter if it goes up or down or sideways. It doesn't matter if it's a market in which volatility is increasing or decreasing. You need strategy if your goal, which I believe everyone's goal is to create profits and hopefully mitigate or minimize the losses that you have in your account. I'm not going to say anything's the best, but this is one of the most flexible strategies, because I think with most markets, you can apply a spread like what you're about to learn over the next couple of slides. Now, from spreads, we can start doing things like iron condors, iron butterflies, calendar spreads, diagonal spreads, but this is pretty much where the origin or the genesis of all of those more advanced strategies build off of. There's rights, there's obligations. We're combining the two of them here. So today's goal, to sort of be brief about it, is to learn the strategy, the execution, and management for 2 basic option spreads. If you get the foundation of spreads from this session, then the session that Ken's going to teach, session number 3 today, which is credit spreads, they're not better, they're just different. And if you get this, then I think you're going to get that as well. If you don't get this, it's recorded, and you can always go back, or if you need to go back for a real refresher, you can go back to our boot camp session that we taught just a few months ago. And of course, once you absorb all this, then we're going to be working on the symposium for you. In fact, as we're going through today, would love to see some comments about what you would like to see in the symposium so that we can be sure that we have that. I think we've got a rough draft of it, but it's never too late for us to go ahead and start modifying things. So let's talk about our agenda. I'm going to talk about a bullish debit spread. I'm going to hit the key points. Then I'm going to dive deeper into a bullish debit spread, something called the bull call. And then the third one is going to be bearish debit spread. So we're just going to flip the strategy on its back for bear markets. I'm going to hit the key points there. You won't be surprised that I pretty much cut and copied the key points for the bullish debit spread. For the bearish debit spread, and real quick, I want to be sure I'm checking my terms. Bullishness means we think something's going higher. Bearishness means we think something is going lower. And again, as options traders, we need to be somewhat agnostic about the market and say, hey, the market's doing what it's doing. I'm going to overlay this strategy because I think the market's either going to reverse or continue, and the strategy I'm overlaying will work in what I'm anticipating out of the market. Get it right, make money. Get it wrong, lose money. Bearish debit spread, I'll talk about the bear put. And then the live demo is basically we're going to be kicking that off a little bit later in the day, where we're going to be teaching spreads on Power E-Trade. And something really cool is that we're kind of cracking into our technology war chest, and Rick is going to show you how to do an option spread using his iPhone. I think Rick's got like a iPhone 3 or maybe even a GS, so we'll see how that looks on the screen. That's a joke, of course. Okay.
I'm using a flip phone there, Sean.
You're using a flip phone. Look, Rick, and you still got the thing on your belt with the flip phone too, I imagine. Thank you. I appreciate the humor. A couple of key points. So we're getting into multi-leg option strategies. This is where we're going to be buying right. So the primary driver of this kind of spread is that you are buying a right. Like if you're buying a call, you are buying the right to buy the stock at a specific price. That's the strike price for a specific amount of time. That is the primary driver of this trade. But we are also, at the same time, going to be selling obligations. And when people see that, they go, yeah, I don't know if I like that. You will, because if you are called upon to fulfill the obligation that you are going to be selling, meaning you're getting paid to take on that obligation. But if you get called upon to fulfill that obligation, you are hitting maximum profit. This is what I hope for with all of my trades, is to consistently hit the maximum profit potential of the strategy that I have put on. So don't shy away from the fact that there's going to be an obligation in here. It's great. That's a good obligation that you're going to want to fulfill with this strategy. There's other trades in which you don't want to have to fulfill on the obligation, but this is one of those, and it's important that you understand when you want it and when you don't want it so you can possibly take action. It involves buying a call, right? So it's nothing different than we're talking about in boot camp. Instead of buying the stock that we think is going up, we're going to buy a call option. But let's recognize that when we buy a stock or we buy a call option, the stock doesn't, even though there's infinite profit potential, there are time constraints. So to realize infinite profit in the period of time before expiration, be it a couple of days, couple of weeks, couple of months, or even a couple of years, kind of unrealistic. So we need to get realistic about where could this stock potentially go in the time that we are buying the call option before expiration. Or we need to use a chart, or we need to use a statistical probability analysis to say, look, I think the stock's going up, but I'm being realistic. It's not going up higher than this level. Because I don't think it's going up higher than this level, I'm going to sell a call option at that level, and I'm going to bring in a credit. And I'll be obligated to sell the shares that I don't yet have, but I could acquire at that higher level that I don't think it's going to get to. But man, if it does, that must have meant that the stock was really moving up at a very fast clip. And again, that's why I'm talking about having maximum profit. So a debit spread is a bull call spread is going to be buying a call and selling a call with the same expiration but different strike prices. You are expecting an upward move when you're looking at a bullish debit spread. When you're looking at a bearish debit spread, you're expecting it to go down. So here's what a bull call spread is. If I say I'm doing a bull call spread on XYZ stock, I'm telling another option trader a number of things. One, a bull, so that means I think it's going higher. Two, I'm using calls plural. I'm buying a call option with the lower strike, right? Let's say the stock's at 100, and I'm buying a stock that's lower at 95 or 90, right? And then that's my long leg of which I have paid money, and I have a right to buy the stock at the strike price all the way through expiration. We call that the long leg of the spread. And then at the same time, but not always, you don't have to do it at the same time, but you, let's say most people do it at the same time. At the same time, you are selling a higher strike. Let's say stock's at 100 and you bought the 90. Let's say you're selling the 110, 10 points higher. That's an obligation to sell shares that you don't have, but you could get them at your long leg strike price. You're selling at that higher strike, your short leg same expiration, so these things will expire on the same day. If they expired on different days, we're talking about a different kind of spread. Same expiration, and it is costing us money. In option speak, that is a net debit because I'm netting out what I am paying for my right and what I am receiving for my obligation, and it still produces a debit to the account. Now, the way that this is, you have to be able to calculate max loss, max gain, break-even points when you become a broker. 30% of the Series 7 is option stuff. And it's, to me, I look back at how much I struggled to try to calculate all these break-even points, and I went, wow, I can't believe I struggled with that. But I did, and I know that most people do too. But it's important that you understand that so that you don't, at the end of option expiration, you're not surprised at how much money you made or how much money you lost. So it's important that we can break all this down. Let's talk about maximum loss. That's simple. It's what you spent on the trade. So if you went ahead and did a 90-110 bull call spread and you spent $300 on that, and your friend says, well, that sounds complex. You could lose a lot of money with that, right? No, I told you I spent $300 on it. So I'm on the hook for $300. That's it. It blows up in my face. Doesn't matter how bad it gets. Stock goes to zero. I lose $300. So I am defining my risk by how much I spent. That's just like a call option. With a call option or with a put option, besides exercising and things like that, but your risk is to how much money you put into it, which is usually, well, it is substantially less than what the stock would have cost you. You're using leverage in that case. Well, we talk about maximum loss. That's simple. Maximum profit is equally simple, but you got to think a little bit about it. Remember I said that my long leg was 90 in my example and my short leg was 110? That's a 20-point spread. 20-point spread, and I was just, off the top of my head saying I spent $300 for it. Well, that would be $3 a share. So my maximum loss is $3 or $300 per contract. On a 20-point spread, that would mean that my maximum gain is the 20 points minus what I paid for it, $3. That would mean the maximum profit is $17. So I could explain, hey, I like XYZ stock. I think it's going higher. I'm doing the 90-110 bull call spread for a net debit of $3 or $300 a contract. And I don't know, I did 10 contracts. So I've got $3,000 at risk. And man, if this thing does what I hope it's going to do, maybe it's not likely, but if it does what I hope it's going to do, I got $17 per share profit. So if it works out great, I'm going to be cleaning up relative to what I'm risking to what I could be returning. I'm kind of giving you some bigger numbers there. I'm about to get into a little bit more realistic numbers here, so I don't want you thinking, man, risking 3 to make 17? Yeah, that would be a very low probability trade, like impossibly low. But I'll get into some real numbers here shortly. Okay, so let's get into the bull call. Hopefully I've defined it enough and it's where you need to be. Let's get into starting some examples here. We're going to build a bull call spread. And the reason I'm using the word build here is sometimes I'll believe a stock is going up, like to the moon up. And so I don't want to limit my upside potential. So I'll just buy a call option. And then 2 or 3 days later or a week later or maybe post earnings, I realize, all right, it's not going to the moon. So I'm going to change my strategy a little bit. So I'll build a spread. Maybe I'll just start with a call option. And then a couple of days later, when it's not shooting to the moon, I'll kind of, set back into reality and say, all right, I still think it's going up, but it's just not going to, go to the moon overnight. Where do I think it's likely to go or unlikely to go? And I'm going to go ahead and sell a call option at that level, and I'm going to bring in a little bit of offsetting credit. I don't want to call it income because it's not. It's an offsetting credit to what I paid for the call. So first of all, you need to understand that I like to trade momentum. So I'm designing this with a chart that is already going up. As a momentum trader, it's my belief that an object in motion is going to stay in motion. And the institutions are the ones that are kind of driving this momentum to the upside or to the downside, the institutional accumulation of shares or the institutional distribution or the selling of their holdings over time drive stocks down. And of course, those institutions are not going to tell you what they are going to do in the future, they'll only tell you after they've done it. Then you'll look at a price chart and go, so it was Berkshire Hathaway doing the selling or doing the buying. That makes sense. Or, it was Elon. Well, that would actually be a little bit more exposed. Okay, current price is $100. I'm going to buy a contract of the 95 strike, and in this case, that's going to be $600. So I'm buying an in-the-money call option. If you went through boot camp, you'll understand that if I have confidence in a stock, I'll usually buy an in-the-money call, which has higher deltas. If you don't know what deltas are, stick around. Dave teaches the Greeks next. You'll know what deltas are. But an in-the-money call that has higher deltas means it's going to participate more on the movement of the underlying stock. Participating more in the movement is good so that when it goes up, I'm riding it more closely. But it's bad in that if the stock goes down, I'm also suffering the movement to the downside as well. But in this case, I'm buying the 95 call, and it's quoted at $6 a share, so one contract's going to be $600. So I'm about to spend $600 by setting up this ticket. Now, I'm going to do it simultaneous. Remember I was talking about how you could build it over time? Well, I'm going to do it simultaneously, and that's usually how I do build my spreads. Now, I'm going to sell the 105. So the stock's at 100. My long leg is the 95. I just spent $600 for it. And my short leg is the 105. So what I'm trying to figure out here is, where do I believe the stock can get to in the amount of time that I'm going to have the trade alive before expiration? And I want to sell a call option that is reachable. In this case, it's attainable, because if I sell one that is absolutely positively unattainable, then I'm kind of leaving credit on the table. But if I sell one that is totally attainable, then I may be leaving appreciation on the table. So I'm trying to balance my predictability with the probability, and I'm trying to bring in as much credit as I can. In this case, I'm bringing in $1 or $100. So I want to bring in as much. Bringing in $2 would be even better. But to bring in $2 might mean that I have to sell the 101 or the 102. And if I sell the 101 or 102, then I'm giving up price appreciation. So I'm balancing this, and in this case, in my example, I'm buying the 95, and I'm selling the 105, and I probably would have done this because I had done some sort of a predictability by looking at the chart for technical analysis, or I looked at a statistical model, or maybe there's maybe there's resistance up there at 105, and again, I'm finding that kind of thing on the chart, or maybe it's just a risk-reward factor that I'm comfortable with. There's a lot of reasons as to why I may be picking the 95, 105 in this case. So I'm buying that 95, I'm selling the 105, and I'm netting the two out. I'm spending $600, but I'm receiving $100, so it's going to cost me $500 in this case per spread in this situation. Now, in the upper right-hand corner, now that I've got these numbers, I can kind of build a P&L, a profit and loss profile around that. Now, before I look at the P&L profile on the upper right, let's just talk about boot camp stuff. If you just bought the 95 strike for $6, well, the break even for buying a call option is strike plus what you paid for it, so 95 plus 6. This stock needs to get to 101 before I can break even. So it has to go up 1% for me to break even. If it fails to go up 1%, I will fail to break even, which means I will lose money. How much can I lose by just buying the call option? The answer is $6. How much could I gain? Infinite. So the upside to the call option is infinite gain potential. But is that realistic? Right? I'm looking at a 30-day option. Is it realistic that this stock is going to go from 100 to 100,000 in 30 days? Of course it's not. So we're working in realities here. But let's keep going with this. So if I just bought the 95, I would have infinite upside. I would have a maximum loss of 600 and a break even of 101. But because I have done the spread, the stock price is at 100, the break even is at 100. That means that the stock does not need to go up for me to not lose money. For the most part, theoretically speaking, it can stay at 100 and me not lose money because I'm already at break even. I would lose a little bit, and I'll walk you through that scenario here. So we have improved our probability of not losing money by doing a spread. Great, I'll consider that to be a gain or something on the pros list of my sheet if I had a pro and con. The maximum loss would happen if the stock were below 95 at expiration. Well, that would be the same if I just bought the call option. But if the call option was below 95 at expiration, I would lose $600. But in this case, if the underlying is below 95 at expiration, I lose 500. Neither of these situations are things that we want to happen, but I think we can agree it's better to lose 500 than to lose 600. That's a gain as well. Now, in this case, maximum gain, if the stock is higher than 105, if the stock is higher than 105, like 106, or even 105.01, or even if it's at, let's just get crazy, $1,000, I hit my maximum gain. And my maximum gain at expiration will happen if the stock is higher than 105 and it's $500. That's the rub right there. You mean if I'm more than right, if it does go up and it explodes to the upside, all I can make is 500? So that's it? Yeah. This is going to be defined risk. I can tell you how much you can lose, and I can tell you how much you can gain. And novice option traders go, yeah, deal breaker right there, because I'm going to buy one call option on XYZ, and then next week I'll buy my yacht. No, you won't. When you trade long enough, you start to realize that people that get started with options have unrealistic expectations about what the stock can do. And after you've not gotten rich on your first couple of trades, you start to assess, wait a minute, wouldn't it have been better if maybe I looked at this a little bit more realistically? And a spread lowers your break-even point, lowers your equity risk exposure, but it does limit your upside. Not going to be any getting rich in this case when you're doing it, but maybe if you can improve your consistency, that's where you need to be, because one trade is not going to make it for you, but one trade could break it for you as well, not to get too cliche here. And with this option, well, it's going to be a 30-day period. I'm just doing that because that's textbook. You could do spreads same day. You could do spreads that go out 3 years. So we'll be talking about that, but I'm going with textbook here. Okay, we've got the bull call spread on. Now that we've got it on, the market can only do a couple of things. We can get into really esoteric stuff like what if they go private, but let's not do that. Let's just stick with what typically happens. The market can go up, it can go down, or it can go nowhere, sideways. So let's hit those scenarios. Let's hit scenario one. Stock rises to 106 at expiration. Hopefully you're with me right now and you're going, okay, if it's at 106 and we're at expiration, so 30 days later, how did that look? Well, stock's at 106. What does that mean? Well, that means this is a pretty good trade, because if you recall what I just said, that a stock that is this underlying stock, if at expiration it is higher than 105, then I've achieved maximum profit. Well, 106 is higher than 105, so this is going to be a maximum profit scenario. But let me explain to you how you're going to make that maximum profit, because this can kind of freak people out. This trade costs you $500 to put it on. But let's kind of break down what happens under this scenario. So you'll notice down there in gold, options that are in the money by at least 1 cent are subject to automatic exercise. Well, the options are about to expire. Because of that little rule in gold, and this is the industry standard, and it's been this way for quite some time. Actually, when I first started as a broker, it was like 25 cents in the money. Nope, 1 penny in the money, you will automatically be exercised at in-the-money options, or I should say subject to that. So watch the 95 call be exercised. Now, this is where people go, whoa, that's not okay, because that means in your account, you'll be buying 100 shares at $95, which would lead to the question of, so I have to have $9,500 in my account, right? No. You need to have 500 in your account to have put the spread on. But because both your long leg, the 95, and your short leg are in the money, you will have an automatic exercise and simultaneously an automatic assign, which means, kind of behind the curtain, we, the broker or any broker, will buy your 100 shares and sell those at 95 and sell those 100 shares at 105. This means 10,500 comes into the account, 9,500 goes out of the account. You do not need to have the 9,500 under this scenario. So you're thinking, awesome. If I buy at 9,500 using money that I don't even need to have, and I sell for 10,500, I just made $1,000 on the deal, right? No, you had a credit of 1,000, but don't forget the trade cost you 500. So yeah, you got $1,000 in, but in this case, you made 500, which was, if you go back to what I was talking about earlier, that's maximum gain because we're at expiration and it has exceeded, the underlying has exceeded 105, which means you walk with $500. Excellent. Perfect trade, perfectly set up. Now, maybe you could say, you know, if it would have been if I would have just done the call option, I would have made more money. Well, think about it. If you bought the 95 call option and the stock was at, and remember, if you just bought the 95 call option, you would have spent $6 or $600. And if the stock, under this example, was at 106, then that would mean that your call option was worth $11 at expiration, but you paid $6 for it. So you made $5, but you had more money at risk and a higher break-even point, which doesn't make it better. But if the stock was 107 or 108 or 120, then you'd say, made 500, coulda, woulda, shoulda, made so much more money. But this is one of the reasons that when we go into a spread, we have to understand if we constantly are hitting maximum profit, that's an okay problem to have. It's sort of like my bonus was super big, so I had to pay more taxes. That's actually a pretty good problem to have because the alternative of not getting any kind of a bonus and not having to pay taxes is maybe not what you really should be hoping for. Okay, that's an easy one. That's what you want. That's maximum profit. Let's go through some variations of that. 1 week later, the stock has soared to 108. You're probably thinking, that's awesome. So I'm hitting maximum profit. You got to listen to my words. Maximum profit will happen at expiration. We're not there. If the stock is higher than 105, it is now, but we're not at expiration. This is definitely a profitable trade. How has this affected your profit and loss? You are definitely profitable, but you are not at maximum profitability. Let me just throw a number out there. Let's say that you're 1 week into a 30-day trade and you look at the spread and you say, look at that. I'm at $400 profit. Here's what I would suggest. Close it down. Take your $400 1 week into the trade and go home. Now, my rule of thumb, you may have heard me say this before, when I'm doing a spread, because you still have, if this is 1 week into it, there's still 3 weeks left that the stock could undo all this goodness that it has done. So if you are going to stick around for 3 more weeks to try to make $100 more, I would say that's poor money management. Again, this is my own rules, and I'm speaking to my own philosophy on this. If there's 20% more profit, but 75%, or I think I got to do my math right. Yeah, that sociology degree is really showing up here. Rick will weigh in on this one. I'll just say 66%. There's 66% of the time risk for 20% of the profit. I take my money. I take my $400 and I go, beautiful. It's like my buddy likes to say, if you're up to bat and on the third pitch, you have gotten to a triple, do you say, just cancel that. Throw me another one. I think I can do better. I think I can hit it out of the park. You're getting a little, I guess, over your skis or big for your britches or whatever. So I like to extract profit if I can make 2/3 of the profit potential in 1/3 of the time. And I have. I've made what, 4/5 of the profit potential in 1/4 of the time. I'm taking it and I'm closing it out. That's my personal money management, at least thought process on that. Okay, let's go to scenario 3. Stock is at 103 before expiration. Okay, so we are in between our long leg of 95 and our short leg of 105. Now, I call this no man's land. This is not something you can look up in Investopedia. This is Sean language that I'm making up. No man's land is where your long leg is in the money, which means you're subject to auto why am I saying expiration in this case? Auto exercise. You're subject to auto exercise on the 95, but no one is going to auto assign you on the 105 because it's at 103. Why would someone want to buy shares from you at 105 when they can buy shares at 103? And I see Joseph is saying, how do you close early? Joseph, great. I'm showing you that right now. So your question is perfectly timed. I appreciate that. So this is no man's land, and what Joseph is saying is, how do you close? He's already ahead of me. You need to close. And, well, I shouldn't say you need to. You'll probably want to close, and let me walk you through why you probably want to close. Remember, something that's in the money by 1 penny is going to be subject to auto exercise, but that 105 is not in the money. So I need to close the spread out. So the order that I put the spread on, I will take the spread off. So first I need to close my obligation by buying to close the 105 strike. And you're thinking, look, we're a couple hours before expiration. I should be paying $0 for this, right? The market makers, the market knows that you need to close out your obligation. So they're going to put 5 cents, right? That's going to be $5 a contract. Why do they do that? Because they can. And this is one of the reasons that we do need market makers, because they're the ones that are helping us to close out. But this is also how they're paying their kids' college tuition and their mortgage. This is their business. Our business is what we're talking about today. You could go do their job if you wanted, but we're doing different things. So you're buying to close the 105 strike, and it's going to cost you a nickel. Why? Because someone's going to pick your pocket for a nickel. But that's how it works. So let's not worry about that. Let's focus on where we are going to make some money. Where we're going to make some money is that 95 strike. Now, that 95 strike, you're thinking, okay, in Sean's example, it's 103. So the 95 strike is 8 points in the money. Therefore, it's worth $8. Then why is Sean saying I'm going to sell it to close at $7.95? Where did that nickel go? Again, the market makers are there to provide liquidity. This is what you need, right? So they say, what you got is worth $800. And I'm not giving you $800 for something worth $800. I'll give you $795, and then the market makers will very quickly offset, and they'll arbitrage that, and they'll make the $5. Why? Because they can, and we need that liquidity, and that's how they put their kid through college. That's how it works. So let's net all of this out. If you're going to buy to close for $5, and you're going to sell to close for $795, if we net it out, you're at what? $790? I think I'm doing my math there. Okay, you're at $790. What did you pay for it? You paid $500 for it. So you make $290, right? I'm excluding the 65 cents commission for the contracts, but you're netting out $790. So you made $290 on the trade. It wasn't perfect, but you made $290 at 500 risk. That's a good trade. But going back to Joe's question, how do you close it out and why do you close it out? This is how you do it. Now, if you don't close it out, and you have the money to buy the shares, sure enough, do nothing at all. That's fine. And over the weekend, you'll buy 100 shares at $95. And on Monday morning, assuming the market doesn't move at open, assuming the shares open at 103, your shares are going to be worth $10,300 that you paid on Saturday $9,500 for. Now you're a shareholder. Now that goes all the way back to just stock investing 101. Now you own shares. There you go. That's it. That spread is done. All right. A little bit more going on, but still that's a profitable trade because we exceeded the break-even point of 100 at expiration. This one's easy. Stock drops quickly to 90 bucks. Okay. Remember the one I was talking about where the stock jumped to 108? This is the flip side of that. How has this affected your profit and loss? You're losing money, right? But maximum loss happens at expiration if the stock is below 95. Well, the stock's below 95, but we are not at expiration. So you're absolutely losing money, but you are not at maximum loss. What can you do? Well, you could do nothing. You could close it out. Remember, I was talking about I'm winning, I'm going to close the trade out, and I'm going to take my money and go on to another trade. You're losing. Maybe the writing is on the wall at this point in time. So what do you want to do? You can close the spread, and let's just change these numbers a little bit so that I'm being very fair and balanced. You can close the spread, and let's say that the spread is worth $100. I know I've got 150 here, but I want to make my examples mirror images of each other. You can close the spread for $100 and take the $400 loss now, or you can do nothing and hope it reverses. Remember, your maximum loss is $500, and that will happen at expiration if the stock is below $95. If this was a stock, I would say to somebody, look, the stock can keep going down, and you will keep losing more and more money. But because it's an option, and because you are using a defined risk strategy like a spread, I'd say, hey, it's your money. What do you want to do? I don't think the extra $100 that you may lose by, do you feel lucky attitude is going to mean that you can't pay your mortgage or you can't pay your kids' college tuition. So it's up to you. But all I'm saying with this is if you're going to have a sell strategy when there's profit on the table, think about what your sell strategy will be when there is loss on the table. And Rick does a whole session on the mentality of trading. Rick, you'll have to weigh in, and I forget what that's called. Leading indicator mind, something like that. But Rick's got a couple of really good points when it comes to our thought process around taking...
Sorry, Sean, it's called managing your mind. I was on mute. There you go, managing.
Got it. Yeah, managing your mind when you're not on mute. Okay, awesome. Thanks, Rick. All right, scenario 5. This one's really easy. So let's say you said, yeah, Punk, I do feel lucky. I'm going to do nothing. I'm not going to take a loss. That's not... Come on, man. We don't do that. Like, yeah, I just won't tell anybody that I took a loss. Well, I'm not taking a loss. I'm going to go down fighting. Great, go down fighting. 30 days later, the stock is at 93. Yeah, so it's below 95, and we are at expiration. This is the easiest example throughout the whole session here. You have hit maximum loss. There's no transaction fees. There's no commissions. There's nothing you need to do except maybe think about, where, as this stock was going lower and lower and lower, do you wish you could roll back the clock and say, man, I wish I would have closed when it was a $450 loss or a $400 loss or a $300. There was probably a point if you could go back and look at it and say, you know what? The writing was on the wall, but I didn't do anything. And I'm preaching to the choir on this one. I do this myself. It's a tough thing because it's only looking at the chart after expiration that you could really see that. But that's kind of one of the goals, I think, is trying to figure out where will I exit it so that I can, like we always say, you can capture more profits versus suffer the losses. So that if you captured that $400 profit and you'd shut this, maybe a similar trade down where you'd only lost $250, well, great, you're still walking away profitable. You don't have to win more times if you can mitigate the risk more effectively. All right, that's the bull call spread. It's really not too dissimilar than just buying a call option, but being true about what you really think is going to go on. Now, let's say that you're buying a call option on, some incredible pharmaceutical drug that is maybe going to possibly be curing some, horrible disease that we humans have. And if their drug trial says that they are, the stock's going to go up 800%. Well, then, yeah, maybe a spread is not what you want. But what if it's just XYZ stock? The stock that 66% of everybody has in their portfolio, Is it likely to double in 30 days? Probably not. That's where I think spreads make a lot of sense. Okay, that's the bull call. And if you get the bull call, let's get to the bear put. So same thing, but I'm just going to flip everything on its back. It's a multi-leg option strategy. We're buying rights, but we're buying puts, which gives us the right to sell. And we're selling obligations. We're selling puts, which gives us the obligation to buy. So we're just kind of flipping everything around. The reason I start with the bull call spreads is that's generally how people's minds work. When I get to the bear put, people are like, whoa, now you're asking me to drive a car backwards at 55 miles an hour. Yeah, it's the same thing. It's just backwards. Yeah, but it doesn't feel like it's the same thing because it's backwards. This involves buying a put because you think something's going down and selling a put with the same expiration but different strike prices. And again, as I walk you through this, I think you're going to get it. This is a downward move strategy. The bear put spread is buying a put with a higher strike. So stock's at 100, and we're going to buy a put that is at 105. The long leg will be higher than the short leg. Whereas with the bull call, the long leg was going to be lower than the short leg, flipping things around. So that long leg is the higher strike in anticipation of something going lower. But we don't think it's going to zero, and I'll show you exactly what I mean by that. And we're selling the put option with the lower strike, the short leg, with the same expiration, and again, it's for a net debit. Now, Ken's going to teach you the credit side. They have the same risk-reward profile, but I don't know. Sometimes I just like getting paid first, so that if I'm right, I keep the money. And if I'm wrong, I've got to give back the money and give back more. When you do a debit spread like this, you pay the money up front. And when you're right, you get back more money than you paid. And if you're wrong, you lose the money that you've already paid. It's do you want to get paid when you start the job, or do you want to get paid when you finish the job? Kind of that mindset. Your maximum loss, same thing. It's equal to what you paid. And that will happen when the stock's price is higher than the long-legged expiration. Remember that 105 put you were buying because you thought the stock was going down? Whoops, stock's at 110 at expiration. It didn't move lower. You were wrong. And because you were wrong, the spread hit maximum loss. Maximum profit, same thing. It's the width of the spread minus what we spent on that. And that maximum profit will happen when the stock is lower than the short leg. Hey, I think the stock's going down. And so I have bought the 105 put, and I've sold the 95 put. Oh, hey, check it out. Bad news on the stock. Stock comes crashing down over whatever my expiration period was. Let's say 30 days, textbook. At 30 days, stock's down at $80. That's below my short leg. Maximum profit achieved. So let's go through and let's build out a bear put. Again, I'm a momentum trader. You may not be, but I'll jump in on a downward trend. And if you look back on some of these downtrends, these post-COVID downtrends like Zoom and Peloton and, I really want to mention a broker that got really hammered, but it wouldn't be nice to do that. So think about some of the post-COVID things. Think about some of the stocks that were falling during COVID, things like Carnival Cruise Line. Come on, the writing was on the wall that cruise lines were really going to suffer during that period, and they did. So bearish strategy, there are times and periods in which there's a lot of opportunity out there, and that you can see that opportunity start to sort of create its own downflow where things tend to move down faster than they do up as that fear kind of builds. So getting excited about bear market trades like long puts, I think is part of becoming an option trader. Not that you're like all doomsday-y, but sometimes the writing's on the wall. If you could short sell buggy whip manufacturers when we went from horseless carriage to cars, and some opportunity there. And all my colleagues know that was a veiled discussion of EVs. All right, current price is $20. We think it's going lower. We're going to buy 10 contracts. Again, I'm just using 30 days, textbook. You do it as long or as short as you are comfortable with. And we'll be talking a little bit about that as well. Buying 10 contracts of a 30-day expiration, we're buying the 21 strike. So in this case, again, I'm using a textbook. In the money long leg and out the money short leg. You don't need to always do it that way, right? Sometimes you can do an in the money long leg and an in the money short leg. That will have a high probability of success. Low profitability, but high probability. Or you could do an out the money long leg and an out the money short leg. That will have a lower probability of success, but if successful, will have higher profitability. So there's this balancing act that you'll start to kind of play with spreads. Very flexible strategy is what they are. So we're buying 10 puts of the 21 strike for $1.60 each. We're spending $1,600. Now, this is just a long put. Let's just say that we're not, quite to the point where we're doing spreads. We did the boot camp thing. This is our start for, getting involved with puts. Granted, if it's your start, shouldn't be doing 10 contracts, but, stay with me here. Stock price is $20. Your break even is $19.40. Why is that? Because we bought the 21 strike for $1.60. Break even point with a put option, a long put, is strike minus what you paid for it. That takes us down to $19.40. Most you could lose is $1,600, and your maximum gain is $19,400. Okay, so hold the thought on this. Maximum gain is $19,400, right? Break even's $19.40, max loss $1,600. Look at that. How realistic is it that you are going to hit maximum gain? That would mean that over 30 days, a stock that has been going down, in order for you to hit maximum gain, would have to go to zero in the next 30 days. Is that going to happen? Let's just say no. It's not going to happen. So let's look at other options, pun intended. Let's do that. So we're going to use a bearish prediction. Look, I think it's going down, but looking at the rate of decline, you do something that's called a measured move. And I'm just going to measure the rate of decline and where I think it's going to be in 30 days. And again, I didn't do this super scientific. I want to hit you with the point. We're buying the 10 contracts of the 21 strike for $1,600. And we're going to sell the same number of contracts, 10, of the 19 strike, and we're going to bring in $600. So I measure the rate of decline, and that gives me a price, I guess prediction is the word, even though I'd prefer to say the word analysis. And that analysis would mean, hey, I believe it's going to keep going down or bleeding out value over the next 30 days. And if it keeps doing what it's done over the previous 30 days, 60 days, or 90 days, we should arrive at about $19 in 30 days. Okay? So selling the 10 puts, 19 strike for 60 cents each, or $600 for a net debit of $1,000. Now, if I look at the P&L of the bear put versus the P&L of the long put, we have changed kind of the dynamics of the trade. Stock price is $20. My break even is $20. That's better than $19.40. It's more attainable. And because it's more attainable, it's more probable. My maximum loss at expiration is $1,000. That you're putting less equity at risk. My maximum gain at expiration, if the stock is below $19, will be $1,000. And I've got 30 days to expiration. Break even 20, max loss $1,000, max gain $1,000, and 30 days to go. I have defined this trade. Same thing we did before. Let's go figure out what's going to happen under the going down, going up scenario as before. And I'll move through these quickly. 1 week later, the stock has dropped to $19. Great, but we're not at maximum gain because we're only a week into it. We're profitable in this case, right? We know about that. Now, in this case, I'm saying, let's say the market value is 1,650 in this case for the 10 contracts. What are my choices? Well, I could close it now and lock in a profit. I'm estimating it at 650. The reason I'm estimating it is I can't tell you what the value of time is because I don't know interest rates, I don't know volatility, but I can ballpark it. Let's say that you could close it now and lock in a $650 profit. Do you want to do that? You can certainly do it. Again, my rule of thumb would kind of apply here. You could do nothing and hope that it stays below 19. And this might be where you dive deeper into the chart. So look for some technical evidence that the stock is going to continue to go down. In fact, if you see some evidence that it may be even accelerating to go down, then you may say, I'm going to do nothing and just keep a closer eye on it. Or I may want to just mitigate risk by setting up some sort of an automated exit. So even though I don't want to exit now, I want to exit if things start to turn against me. Turning against me would mean, maybe the stock starts to reverse. Maybe we start to see some dojis, some sort of leveling out, or on an up day, an increase in volume, or on a down day, a decrease in volume. Just a little bit of evidence that maybe you need to take your money and close the trade out. And if you did want to close it out, you really just need to buy to close the 19 and sell to close the 21. We're just reversing the trade that we put on. Scenario 2, price falls to $17 at expiration. This is easy. Stock's at 17. That's what we wanted. It's below 19. Now, the only thing I'll say about this one, options about to expire, is in this case, because our maximum gain was happening at 19, and we're at expiration, and it's at 17. Understand that as a stock is falling, continues to fall, what you'll notice is that sometimes it accelerates its rate of decline because fear is sort of starting to generate more sell pressure. Whereas as stocks go higher, people start to become reluctant. Wow, I don't know, Tesla over 200, yeah, Tesla over 225. I don't know. It seems like it's getting too rich. It's overextending itself. Whereas as things fall, they drive that little bit of market panic going in. So what I'm trying to illustrate here is recognize that if you're right and the stock does fall from 20 to 19, that it may actually be coming more heavy and accelerating its fall down. Gravity may be grabbing hold of it more. And in this case, because it went to 17, great trade, maximum profit. But remember, the nature of falling stocks is different than the nature of rising stocks. Okay, so let's walk through this. Under scenario 2, we're auto-exercised to buy, to sell 1,000 shares at 21. Simultaneously, we will be buying at 19. When you buy 1,000 shares at 19 and you sell at 21, there's a $2,000 credit in there, not $2,000 profit. It's $2,000 credit minus what you paid, $1,000 profit. Excellent trade. Maybe could have been done a little bit better by recognizing the nature of a stock falling. Sometimes accelerates that rate of fall. Scenario 3, stock falls then rises to 20. Stock is still at 20. So what I'm really trying to show here is that the stock fell, but you didn't close it out. And then we kind of resumed and got back to 20. Options about to expire. What do we do in this scenario? Well, we're at break even, technically speaking, but we need to close this out because we're stuck in no man's land. So even though technically we are at the break-even point, the fact that the market inefficiencies, for lack of a better word, just the market, the way the market works, we need to buy to close the 19 strike for a nickel. Well, you're thinking, shouldn't that be for free because it's worth nothing at all? Yeah, market doesn't work that way. So we're going to buy to close for a nickel there, and then we're going to sell for 95 cents. Wait, shouldn't that be worth $1? No, market doesn't work that way. So we're going to sell that out, which means in this case that we are at break even, but we're going to lose some money. Not a lot here, right? What do we got? 95, so $900. Yeah, we lost $100, and plus a little bit of transaction costs too, 65 cents per contract, or if you're an active trader, 50 cents. So not a lot, but again, technically break even was $20. We're at $20, and yes, you still lost money because of the way the market works. Scenario 4, stock price rises quickly. Now remember, this is going against you now because it's a put spread. So in this case, we're 1 week into it. Stock has risen to 21. How has it affected the P&L? In this case, you're losing money. The market value is 35 cents. That's $350. What are your choices? You can close it now, take the $650 loss, right? You can do nothing and hope the price drops to $19, or you can automate some kind of an exit or alert. Same scenarios as we talked about before. How are you going to manage a gain? How are you going to manage a loss? Well, in this case, let's just walk through the total loss scenario. Stock's at 23. Current price is 23. Options about to expire. This trade has gone bad, right? I don't want to say it's gone south because it hasn't. It's gone north in this case. We are at expiration. We're higher than 21. You don't need to do anything at all. You're at your maximum loss point. That's fine. That's how it goes. They're both going to expire worthless. And when your long leg and your short leg expire worthless, the trade expires worthless. Let me hit you with a couple of takeaways, and then I will go to wrap and get my throat taken care of too. All right. Trading vertical spreads is a way to trade a directional opinion and to define the risk and reward. Defining that risk and reward means that you can do trades like this in your retirement account. I do a lot of spread trading in my retirement account. They're more complex because there's more moving parts, but to me, I basically focus on the benefits of the spread. Each trader will need to determine the right balance between risk, reward, and probability. We'll dive deeper into that later. Set up a few bull call spreads and bear put spreads using E-Trade paper trading. The paper trading, which is more like the Power E-Trade simulator, you already have option approval in there. You will need to get that for real money trading. There's $100,000 in there. Fake money. You get real quotes, fake trades. It's a great place to practice, but I'd say don't practice forever. Get out there, and if you want to do this, put some money. You will learn even faster, but keep it small. Keep it really small. And you will need to be approved for options level 3, not because this is more risky, but because it's more complex. So if you're options level 1 or options level 2, you will need to request an upgrade on each of your accounts to be option level 3, and you'll find the link to that in the resources tab. I am 2 minutes beyond. Still gives everybody 13 minutes. Rick, I'm going to check with you and find out where we need to be, if we need to go ahead and wrap and give everybody a quick opportunity to catch their breath.
Yeah, Sean, let's go ahead and wrap. Next one coming up here in 13 minutes, understanding and using the Greeks with Dave. Thank you.
Terrific. Thanks, everybody. We'll see you at the Greek session.